Welcome to Exit Algorithms, the podcast where we decode what it really takes to scale, exit, and preserve the legacy of your business. Today, I'm honored to be joined by Charlie Heaton, an industrial financial consultant with over 22 years of experience and track record of closing deals up to $400 million in value with companies like Stearns and General Electric. Charlie specializes in forensic accounting that reveals hidden value in businesses, helping companies achieve higher profit multiples through cost segregation audits and strategic tax positioning. We're focusing today on what actually makes a business valuable at exit, beyond just EBITDA or profits, and the hidden deal killers that can cause exits to fail during the due diligence process. Charlie, great to have you, man. Welcome to the podcast.
Thank you very much for having me. Appreciate it.
Yeah, I'm excited to get into this. I've got a lot to talk about. It'd be good for listeners if you could start off, share a little bit about your background
Sure.
in industrial finance. Tell us about your journey and how you got started in business.
Sure. I went to school to be more of a pilot with Eastern Airlines back in late 80s and early 90s. And then when Eastern Airlines went bankrupt, it rocked my world. Because you can imagine, here's an opportunity you, as an airline pilot you wanted to do since you were a child. You spend time at the airport and talking with pilots, going into the cockpit, and you're already on your journey. And then out of the blue, no notice at all, the very school that you're in, the guys that who flew for them for 30 plus years are no longer having a career. Literally, they lost everything. They lost their retirement, their pensions, everything with a flip of a switch. And since then, it opened up the door. It hit home to me very, just deeply. Because here's these guys, they did all these decades of a career and devoted to one skill set. And at the end of the day, they lost it all because somebody else was at the helm. And ironically, it was the same time when Continental Airlines was in their first phase of bankruptcy. And so here you had thousands of pilots who all of a sudden instantly lost their job. And then you had Continental, who was also on the verge of doing the same. And so it made me do a switch. And it was so neat how the man upstairs works. I'm a Christian by my faith. And so you're going to hear me references, I hope, a couple of times during this opportunity here, that a gentleman entered my world who happened to be from Harvard, of all things. Didn't have an interest in it. But our mentalities just hit it off. And during this time of school, I started trying to raise money for my own opportunity. And back in the day, you had these little kiosks that went into hotels that you can go up and push a little code on a little phone that was connected by a cord, and it was designed to go into these smaller type hotels where they can go up and go, hey, I want to go to a bite to eat, whatever, and it's instantly there. I was trying to raise some money, small amount of money. This gentleman, he let me bump my head to all these management companies and finance companies and pitching and trying to present my business plan and what I wanted to do and trying to raise money. And I floundered. It wasn't working. I was so frustrated. He said, now let's raise money for other people. I thought, what? The very thing I struggled with, I lived it and breathed it, I struggled with. And I could not seem to get it off the ground. And before long, after I took him up on his advice, one of my largest projects entered my career of $400 million in pitching to Bear Stearns, Dean Winter, Smith Barney, taking the lead role in that. And the heavy industrial refinery project, diesel fuel, jet fuel kind of project. And it just opened up my door through other attorneys and accountants, and they saw what I was able to do and the doors I was able to open with, GE and Westinghouse and Halliburton, Brown and Root from oil and gas. A lot more oil and gas kind of focus, heavy industrial. That's the reason for the nickname. And just more refinery, manufacturing, finance work. And it just blossomed from a variety of different industries and opportunities that came across my space. But it ultimately led to, when it's crisscrossing the country, traveling the country, pitching exit. And they go, congratulations, sir, you're trying to raise X number of dollars. That's awesome. But at the end of the day, you're still 72 years old. When is enough? And it was the most fascinating thing, fascinating discovery, more often than not. And they look at me square in the face and they say, what do you mean? They said, we got a great opportunity here. We're trying to grow it. We spent all these years of doing all this stuff. At the end of the day, you're 72. When is enough? I said, I don't get it. So what do you mean? I said, sir, you're going to work till you're 90? When is enough? And many of them had their aha moment. They said, I really don't know. What triggers that? Is it a good event or is it a tragic event? Is it where you lost a spouse? You've been diagnosed with a terminal illness? What is going to trigger that versus hopefully not by default?
Mm-hmm.
And it really opened the door of going, guys, understand the exit is the easy part. Because at the same time, I'm courting venture capital firms, private equity firms, investment banking firms. And it became where a lot of their companies, the ones that are too small for their portfolio, they don't want them. And you'll find that if an owner is really wanting to cash out, the fun part here is educating that owner. I'm going, sir, you're 1.2 in EBITDA, 1.8, whatever. You're 3. At the end of the day, you don't have the systems strong enough so that you can get to the 3 million in EBITDA or about 12 million revenue or about 120 employee bracket. You're flat out too small because these institutional buyers, they don't want you there. They want to cash you out and be done.
Yeah.
When they finally have that aha moment, then I don't want to be carrying a note. In this case, joint venture with me. Roll up an opportunity where I can bring in other technologies. And one of the things that a lot of, whether it be from students or the audience, when they recognize under your SIC code, your standard industrialization code, how is it registered? Is it registered as primarily as a service, or is it primarily selling a technical product where you own the technology, not leasing the technology? You're not a franchisee. You're not a licensee. You're the owner. You created it. You own the patent. Because the difference of valuation between the two is phenomenal. From a traditional service, you're going to be about a 2 to 3 plus value plus goodwill, or plus assets plus goodwill. But when you start getting into more of your technical, now you jump it tremendously, where you don't have to have 10 million in EBITDA in order to still command in that upper single digit exit. You don't have to have a staff of 500 to 700 plus people for a 50 to 70 million dollar business and 10 million in EBITDA in order to get a 10x.
Right. Yeah.
You don't need
So what drives those higher valuations?
the technical devices. It's proprietary. It's not a commoditized skill set. It's a proprietary skill set. So in other words, it's not like, let's even go all the way back to how our paths cross from the home services. And the home services is more of a commoditized skill set. There's nothing really proprietary unless they're selling their own technology.
Sure.
Okay. Now, if I add devices that I can own the proprietary rights to it, in addition to more of the HVAC, or in addition to the plumbing that's really going to help a homeowner that many other plumbers don't have access to. Now I've got a whole different item. But if you're to say traditional, let's say a home services without the technical products, it's going to make it very difficult other than your traditional roll-up route of trying to get into that 10 million EBITDA space versus a 3 million EBITDA space. And the fun part of this, you don't have to own these very long. This is not like when you have to go in and hopefully someday, maybe 10 years later, I can maybe exit. But a lot of these owners don't know what that exit value is. What does that look like? What does a simple closing statement of your business look like now? Where do you need it to be? And they don't know. That's what makes our job fun. Our world of discovery and our world of making the unknowns known, the picture of a tunnel. Because that's my photo when I used to lead these Jeep tours up in Colorado. And I was going through my little trails and whatnot, and I come up to this particular tunnel. I'm a Christian by faith, and so God said, I want you to get out. I want you to go stand in our tunnel. And he said, one day you're going to be standing up on a stage one day pitching hope into people's lives, all because of being inside this tunnel. And when you understand the true value of what that means, you're in the darkness here, you're on quicksand. You see the exit, but you can't get there. And it's because of a little bit of tweaking. And so it makes it fun for you and I, the association or the teams, Carl and Chris, have been able to function together and educate these owners of what does this look like? Are you going to get a cash out price? What does that look like? Why would you have 40 years of your work going into a big chunk of that in tax? Why wouldn't you have that going into, I love what's called a charitable remainder trust, where you can donate. I'm not a licensed financial advisor, but as far as an overall concept, where I raised or shaved my head for 71 people in my life circles that have had cancer, leukemia, 35 have died. And so for mine, I've got a massive passion for friends of mine, people that in my world, people with cancer, leukemia. And Mine is more of where would the proceeds go of more of a nonprofit donating it to a trust. So that entity is actually able to receive the trust, and then you're able to live on the interest of the trust, and that's how you would take care of your tax. And so instead of paying it at one lump sum, now, of course, I'm not a financial advisor, but as an overall concept, and of course, definitely for the audience to seek their advisory on that, but it's called a charitable remainder trust. And it's perfect for these owners to do that. So they don't have to worry about that big tax issue when they sell it.
Yeah.
So
Can we go in a little further on taxes?
sure.
Could you explain cost segregation audits
Oh,
also,
yeah,
and
absolutely.
how that ties in?
Yeah, absolutely. So let's say you're focused on companies who have a big building. And back in the mid 90s, the IRS was sued by a company called Hospital Corporation of America, Little Bitty Hospital, HCA. HCA went in and said, IRS, they said, we spend billions of dollars every year on our flooring and fixtures, lighting, and keeping our hospitals up to code. Why are you requiring a 33, 35-year depreciation schedule on items that are only good for really 2 to 3, maybe 5 years tops? Long story, the IRS lost. And so what a cost segregation audit does is not done by your traditional accountant. Most of them are done by very specific engineers. It's a whole different level of audit. It's expensive. I mean, you're about $100,000 to almost $200,000 for an audit, but it's worth it.
Wow.
Because you have a carry forward that can go over to the new buyer. And I spent some time with even I call them my Baldy twin guys at the, we all kind of related to the same barber, at the conference there. And I went up to them and spent some time with them. And I said, if the owner hasn't taken advantage of a cost segregated audit, and there's on the traditional 33, 35-year depreciation schedule, how long do I need to own the business before I can execute my own cost segregated audit so I can take advantage of that savings? And so he said, you know what? You don't have to own it very long. He said, the hard part is that if you want to exit it, is that if you want to keep the business for a long time, you could take advantage of that. Basically, it's a court-forced tax credit. It's a tax credit toward future earnings because of the depreciation schedule is going from a 33-year to a rapidly depreciation schedule of maybe 3 to 5. Well, when you've got millions of dollars in depreciable items, that is huge toward a future buyer because that tax savings is phenomenal. I mean, you could be 6 and 7 figures, even more in tax savings, all because of a rapidly increasing depreciation audit. And so the hard part is that if your strategy like mine is to more get in, get out. And so you would have to recapture those earnings if you got out in a quicker time frame, as compared to allowing you to ride the cycle of it if you wanted to keep it for 10 years and just didn't want to get out of the building. So those, of course, you want to definitely seek advisory from your financial professional advisory. But it's some things that of a cost segregated audit for the students to look into, as well as a charitable remainder trust. But you want to make sure that you have that already set up of where would the proceeds go when you exit? What does that look like? Is it better for me to have a longer term passive income? Some people want that. They'd rather have more of a mentorship or guidance of mentoring the owner, but they're never truly retiring if they do that. They're always going every week. We're getting a phone call. I'm mentoring. I'm worried about the payment. Am I going to get paid on my legacy? And it's like, well, why don't we just put a peace of mind to that and let your financial advisor help you there of what to do? Because right now you're too small to cash you out. And so a big chunk of this is going to be carried. And what happens if it's not bankable? If the SBA after 8 months comes in and says, sorry, sir, we can't do this opportunity because of you've only got 5 customers and who make up your entire business, as an example. Or you have, this is mainly the customers know you. What is the likelihood of without being a government contract or a traditional commercial contract of it carrying forward? And I spent some time even with Brittany there at the BBD at the conference and asking her, I said, well, with the commercial contract, a lot of these guys are good old boy Bubba handshakes. Down south, we meet them in the barbecue function, at a deer function, 4-wheeling or whatever. Good old boy, blue jean kind of boots kind of guys. More non-formal, creating business opportunities. It all started out with a barbecue dinner. And I said, but what is the likelihood if 70, 80% of these customers are good old boy Bubba handshakes? What makes you think they're going to go over to that new buyer? And Brittany came in and said, that's very real. That's very possible. And so I could have so much fun if the opportunity ever permitted itself of digging deeper into more of a teaching or coaching, that due diligence phase.
Sure.
of really dialing in, because the more issues that potential acquisition has, the better for you as a buyer.
Mm-hmm.
One, you're not bankable, sir. Number two, you're not bankable. Number three, you've got a lot of these customers like we mentioned, but Charlie, I still need out of here. How do we do this? See,
Yeah.
now you've opened up a much, much better opportunity. They're going to be paying you to come in there and take them. So my intention is to roll up scale to exit here and not create a 20-year job. You've got some basic infrastructure. It just needs to be revamped.
Yeah. Yeah. I want to touch a little, double click on one of the things you mentioned, which is revenue transferability. So how do you
Right.
evaluate that during the due diligence process? Whether a business's revenue will survive the change of ownership, and maybe what are some steps the business owners could take as they prepare for exit to prevent that and make it more attractive to buyers?
Sure. You mean more of the transfer of value. You remember you're transferring over the it's not so much the revenue, because everybody does their books different. That's the hard part. One of the things I want to encourage your audience is definitely you want to have an adjusted EBITDA audit from industry standard, because in some cases, the companies want to have very little that they show that from of an earnings, but unfortunately it kills their valuation. Well, if I'm basing my valuation based on what they're showing as compared to behind the scenes, I'm going to have an adjusted EBITDA audit done. I'm going, well, so you're showing me an EBITDA here of 400,000. But I do my audit, I'm at 1.9. Well, I know that if I can get this, I can get it to a 3. I'm over halfway there to my goal. I'm going to give him whatever terms to make it work as wild if he's going to want 2 to 3x based on that first number. So it's not so much from the revenue side, I'm more from the earnings side. How is earning driven? Very important is how much is reoccurring. So I sell it one time, I'm getting paid over and over again.
Mm-hmm.
As compared to it's a one knockoff sale, and technically you're only as good as your last sale. So what makes me think that those, especially if they're more of a consumer, an individual versus a business who is a primary customer, like guys who want to do in their home services, but they have where majority of their customers are more residential based. Well, is that insurance pay? Is it cash pay? But what's likely they're going to come over and over again.
Mm-hmm.
So the transfer value, you've got some technical issues there that you really got to look into deeply, because I prefer to have one that's 60 and 70% commercial, but especially if they're more government related contracts like municipalities.
Mm.
Because the strength of the payor is huge in the transfer value. The valuation is going to be higher if I know that I've got a municipality as a client, or if I know I've got somebody who's not a good old boy Bubba relationship customer, but who is actually a true property management company, for example. Let's say you want to clean skyscrapers or whatever type contractor. I had somebody pitch me one of those. And I said, are they property management companies? Are they good old relationships? Is there all just relationships? I said, you don't have anything. Is there anything proprietary? No, it's just, I said, you don't have anything. That owner could go file a new business name, and there are big old buildings he could fly in, and you got nothing.
Mm-hmm.
And so is the quality of the customer base, and how can I strengthen that even if the EBITDA stays constant, how does that valuation still increase? Because you could still,
And
okay,
that's another question I want to ask you about. Touched on it before, but I love to hear your thoughts on, besides EBITDA, what makes a business valuable?
Strength of the customer base, strength of the reoccurring revenue.
Mm-hmm.
The desire from that owner is how long is he going to stay with me? And if majority of his customers know him, what's the guarantee that those customers are going to follow?
Yeah.
If those are, he said, Charlie, I'll stay on with you all the way through to exit. So I can get a much better exit for all of us here. If you'll stay on with me all the way through, because my end all exit is going to be more of an institution, not your Betty Joe, Sally Sue buyer. It's not going to be an individual buyer. I've already got them in mind. That's the reason why I'm pitching you. I'm already coming there. I know what they're looking for. I'm going to call it discovery of dysfunction. That's going to spook a good transfer of value. And so it's that level of dysfunction is what you're diving into. Where's my dysfunction within this organization? Where's my skeletons within this organization? Yes, on numbers wise, it looks good. It looks profitable. But what's the strength of my customer base? What does my aging report look like? Meaning, are my
Mm,
receivables at a mess of a 120, 180? Do I have some that are net 90? How many of those that even defaulted? Do I have any of
yeah.
those that count for more than 10% of my overall business? And if some of them, I'd never forget this, some of these are 80% of their customers are all 120, net 180.
Wow. Terrible.
How do you function? How are you paying your vendors and suppliers and your overhead? And what in the world? That was the
Yeah.
example I gave to you, that always in your due diligence, finding out what is the largest client. This is as an example, but your students can take this forward. This was a real deal. This was over 10 years ago. And I said, gentlemen, our paths crossed. I said, well, he's an engineer. And I said, what's your largest client? He says $3 million. I said, that's great. I said, what margins are you? He says 40 to 60%. I said, oh, that's awesome. And I said, but if I'm your next largest client at 6 million, what happens? You could hear a pin drop on that phone. Total silence. And he said, Charlie, to be honest with you, he says, I walk away from a $6 million contract at 40 to 60% margins, all because of your internal credit facilities aren't set up correctly. He says, as a financier, I love your problem. Because for guys who love financially within a company, I'm not day-to-day managing people, but more from a behind-the-scenes finance, that's an easy problem to fix. But somebody who's an operator, my missing link for your audience, they know how to manage people. I'm not a manager of people. I had a staff of 7 on my payroll over almost 20 years ago. And I've discovered my Tourette's kicks in, and I discovered I hated managing adults. Because now you're sitting there twisting your head. You're going, what in the world? How is this even happening? I learned that I couldn't have that staff of 7 on my payroll. And I found that it wasn't my cup of tea. I found that I didn't enjoy it. And that's for even the audience. There are people who know technology or who know how to manage adults. They're going to have a staff of anywhere 25 to 120, 130 people under their leadership. But if they have that knowledge, how to do that and how to implement systems, that is a huge missing link for me. If they know how to go in from an operations and literally take it apart, discovery of dysfunction, and how they
Yeah.
can help
Yep.
out, there is phenomenal opportunity, even for the audience base there, that if they have that knowledge. I'd love to meet with them. That's the missing link for me. I'm not an operator mentality person.
Sure. Yeah, the statistic is over 50% of deals fall through during due diligence. And you mentioned there's skeletons that can spook buyers and destroy the sale process. What do you see as the most common skeletons? I know you mentioned customer concentration. Is that probably your top?
That's huge. That's top. What is the biggest percentage of customer base that counts? Do I have some that count for more than even 20%? 20%. If I can get it down to 5 and 10%, I've got a lot of customers that have a variety of different options. Majority of them, I prefer more commercial contracts as compared to residential individual contracts. Their process for creating that contract, servicing it, by the time I've manufactured it, especially the manufacturing guys that are out there, they know this. My build time is huge. It may be 6 months out, and I'm paying for all my suppliers. I want to know that if I need to get financing based on that commercial contract that I have, it's very difficult. I have to look 2 to 3 steps ahead in a chess game. I know my move in a chess game 2 or 3 steps ahead. If they do this and I'm going here. If I get a bigger contract, I know how I can fund it. I'm not worried about turning it down. I may have some infrastructure side, but I may have to delay the lengthy period of time of the contract, but at least financially I can take care of it. And my vendor relationships and supplier relationships are in order. Making sure that I don't have a business model based on 2 or 3 customers. Making sure I have many. Making sure that I have multiple streams of income even with one customer. Making sure that I've got reoccurring revenue. Is it a one knockoff sale? If it's a one knockoff sale, is this valuation based on you? Congratulations, you got a $9 million contract. What's your average contract? 200,000. I have to take the average of your contract, sir. I can't take your one hoorah hero and all of a sudden thinking that's going to, keep my EBITDA constant. It's a massive jump. So it's how the strength of those contracts, customers, the strength of those that are, where's my average of the customers? How long did it take them to pay? What are my terms? Am I net 30, net 60? How many are net 90, net 120, or even more? How many are even in collections?
Yeah.
What is
Bad debt.
for bad debt? What is the credit strength of the company? Do they have
Yeah.
low scores or do they have bigger ones? How much unsecured money can I obtain just with that strength of that EIN number?
Mm.
After the purchase, I'm going, well, gosh, I got really high credit lines. Well, how much of the credit lines are even occupied? Well, if I got 90% of my credit to debt ratio occupied, well, wait a minute, I'm buying a company completely in debt and they want me to get new debt to buy it.
Yeah.
Where are my credit lines from the financing of it? How much is he willing to carry? Can I even debt service that? I'm already learning some of that stuff. But very important is that the amortization schedule of that debt. I used to love bond issues because bond issues, industrial revenue bonds back in the day is what they were called, because I had a 20-year amortization schedule on real estate and equipment. Well, now if you ask your SBA guys, a lot of those are going to be 5 and 7 years, maybe or maybe a 10-year with a 5-year call, as compared to a 20-year flat out amortization schedule. Of course, back in the day, you can get 6% money on a 20-year am. And
Wow.
so,
Yeah.
it was, huge difference. This was, holy cow, this was what, 30 years ago. So it's the strength of the customer, the financeability of it. And also, you remember, I've even asked Chris and Carl this on one of their Zoom meetings, that where is the point of management control and ownership control? Because I relate that if I'm going to have an equity buyer that comes in and helps me with my down, you start getting into bigger opportunities. At what point is their input needed? Do I have to have a customer, or do I have my own financing set up as a mother may I? Mother, may I do this? Mother, may I do that? May I do this? I'm going, I got 552 decisions I have to make every day with my business. So I really have to get the Congress approval here on every decision. So I was asking Chris and Carl, at what point is there a difference of ownership control and management control? Because I have to have one chief, not 10. Because one of my prospects, a guy I'm literally known for 20 years, and he's in this nice opportunity. I said, how many shareholders? He said, Charlie, got 41 shareholders. You've only got 100%. What a nightmare. It's not just down to one, but I would say the biggest one is the strength of the customers and the carry forward. If there's real estate involved, is it a straight up cash flow deal? Is it an asset plus goodwill? And how do you value goodwill? Because if 90% of the customer base is based on the owner, what is the likelihood of those being carried forward, especially if they're consumer clients, individual consumers, as compared to commercial clients? And then you better not have one customer who's got 90% of your business. You're dead. You better not have one customer that has more than 50%. If so, it's dead. As far as from a financeability, but as far as creating opportunity, that's a different deal.
Sure.
Because it's because of that concern he wants to sell, but he can't, because it's majority of his customer base is sitting up there at 50% or better and going, sir, you're not bankable. I like your opportunity. You're still profitable. We can do some amazing things with this, but you're just flat out not bankable at this time. So hopefully that answered a long way around the front door to answer your question.
Yeah, no, absolutely. Thank you for expounding on it too. And in talking about what can kill the deal, I know you mentioned the psychology aspect a little bit earlier. It's a common thing that can the seller's just actually not ready to sell. Do you find that in what triggers a business owner to finally seriously consider exit?
Pain. As a 2-time divorcee with a broken engagement under my belt, I hate acknowledging that, but it is what it is. And knowing that if I had a spouse that was involved in my work, or a partner even, that where it's not their board of directors, something's going on and they're just not happy with their partners or what have you, squabble within the partnerships. It's more of a pain issue as compared to a greed issue. The guys with pain are going to listen because they want out. The ones who are trying to sell it for greed, they're the ones who are sitting, we're going to get 6X on a commoditized skill set, and good luck. I wish you well. No, you're not, but okay. But on the other side of going, Charlie, just give me 2X, pay me over a period of time to get me out of here. I said, well, now the fun question that to encourage everybody to ask of, sir, once you sell this, what do you want to do next? Charlie, I've got 8 grandbabies that are 2,300 miles away. How often do you see them? Rarely. How come? Because I work 80-hour work week. So we can come here and leave this and come here with the terms that you needed or the price you needed. So you can now spend more time with your grandbabies out that are 2,300 miles away. How soon can we sign papers? We have a phenomenal team waiting to come in and take over. But understand something, sir. When you understand, my goal is to make the one of giving you a full price offer, because I like the area that I could take this and the technologies that I can bring. Number two is I know my buyer and I know the strength of where they want to come in to cash us all out. The question is that I can now make a smaller percentage of future earnings worth more than 100% of your existing price. So all I need now is if you'll sign this so we can now move forward into a mutual letter of intent to move forward, because now he's realizing what it is. But now, as far as the reason for putting it off, is to realize you're going to put this off, and 10 years later, now all your grandbabies are going to be adults. They're going to say, "Where's Papa?" Oh, he was busy working his 80 work week. So does it take a travesty to get them to move? Or is it they're already past that point and they're already in that travesty and they got to move? If it's the guys who are greed, walk. Just walk. Find you another one. Next. If you'll zone in on the ones that have a true, genuine pain, it's relieving them of this pain. It's as if you're going through a divorce and somebody comes in and they understand your situation, and they come in there and they knock on your door and going, "I know your situation, but if you need to get rid of this house right away, let us know." So I don't got to mess with it, right? Yes, I can go with the realtor, but I don't care. It's not about the money. It's relieve me of this pressure. And when you finally get a chance to do that and they see that you're sincere about relieving that pressure, it's not about the money anymore. It goes a lot deeper than that, and relieving that pain issue of life that we all go through. Unfortunately, they want to wait until a medical issue comes up or a squabble, marital issue, partner issue, what have you. They're going to want to wait until that happens till they finally decide. And now you've got a whole bunch of hurdles you got to overcome, because now you can't get anybody to agree. Everybody's going to butt heads and you go, "I can't even get a 51% vote." Guys, this is going to make it difficult even with your new buyers, because I promise you, my buyers are going to come in there and take you all out. They don't want you. They're going to bring in their own team. They're going to start from scratch. They like your model, but it's because of your team. It's what's got you in this pickle in the first place. You all got to go. So all I need is 51%, and I can go in and take it over, but you're going to get button heads. So the biggest thing is having them focus on that pain issue and relieving that pain, and all the other stuff. Don't zone in on that. It's so hard to negotiate the terms that you need as compared to actually having action that's taken. Because I promise you, you're going to have months and months. Well, we need to think about it. Well, we got to evaluate it. And there's not going to have any kind of decisions. But if it's a pain issue that you're trying to overcome, they're going to be ready to move. And if you set the intention of your meeting, I'm not going there, sir. I'm going to send you all my letters of intents and terms and conditions before I fly down there and take a tour. And let's make sure that this meeting here, this final contingency on me signing is on my contingency, not yours. But here's my intention, is to come to an agreement here at potential terms and conditions and sign on it. Take it to your lawyer and accountant before I come down. So all this is already signed and blessed by your attorney. It's all good to go. All of my financing and everything's already ready to go. But this final contingency and me taking the key here is on me. I need to be convinced that this is the direction I want to go. And as long as I see that this is worth its while, we're ready to move forward and change ownership. If you're not, I don't want to waste a flight, because you'll find that now I've set the intention of where I need to be. And there's none of this surprise when I get down there about this term. Everybody's already agreed. I don't have to worry about the contingency of the attorney and all this. Everybody's already approved.
Mm-hmm.
And there should be. So at the end of the day, sir, if I come down there and I find everything is validated, not only through our video tours and everybody's gone through it, all the financials and the adjusted EBITDA audit and all the stuff that we've done, that we're ready now to sign and move forward, to relieve you of this headache so you can now go spend time with your grandbabies. Correct. So now it makes it so much easier in your close and setting that intention. So when I'm going through and looking at this and being able to overcome some of these issues, what we just mentioned, now there's really should be no reason why we couldn't move it forward. But it has to be on his space and the realization going, "Oh my gosh, I'm getting ready to release control over my baby." If that pain is not set, you won't close. You won't, because all of a sudden, if it's not confirmed, I'm looking at buying this, sir, because of this pain issue where we need to move on. One of medical or what have you, like we just mentioned. And as long as that is set in place prior to going, I know I need to take action, and having them affirm that I know I need to take action. We're coming there to take action today. Not there to be a looky-loo, say how to do. I'm sure you're a nice guy in person and all, but at the end of the day, I'm not coming there to leave there without signatures done. Signatures already need to be completed. So now it's not to worry about going there, pad and pen in a briefcase and going through everything. It's already been gone through. It's more of getting a chance to know them. And they might decide, you say, guys, I like the way how you handled this. What are the possibilities of creating an amendment to stay on with you a little bit longer? So let's come down and take a tour and then spend a little time with the board and see, making sure we're all on the same agenda. Understand, guys, this is not a 20-year deal. This is a maybe 3, because the buyer's already built in. Our exit's already built in. I'm going down there where I already know my buyer. I already know what they need from me. It's just that's where I need help, my help, from hopefully your audience that's out there who has that level of experience to help out once you get to that point, who can help me in that fixing dysfunction once I've got it under control. If they know how to do that, I'd love to have a chance of talking with them. That is a huge missing link for me.
Yeah, absolutely. There's two sides of the coin, right? I think it's important also as a seller, especially the seller, knows why they're selling and what they're going to do after the afterlife. Because that can easily kill a deal. Charlie, we're wrapping up on time here, but I just wanted to ask one final question. I love your quicksand tunnel analogy. If you could give one advice to business owners to position their business or take one step towards a successful exit, what would that be?
Reach out to us, reach out through your podcast. You know how to reach me, and to spend a little time with them for free. I don't want anything from their time. I want them to see the options, option A, B, and C. And I'm coming to them now. I'm right at 36 years in February. This February will be 36 years of courting private equity and venture capital work. And so now my exit guys are courting me. And so I'm going to say reach out. It's not necessarily one thing. It's more of acknowledging the question that if I were to sell my entity that I spent 40 years of my life building, what would I do next? And have them come to the table, reaching out to your station and podcast here, and say, I want to have just a meeting of the minds with Charlie and just open it up for discussion, because I now have grandbabies that I haven't seen in a decade, and this business is controlling my life. And so it's not so much one particular issue. It's more of just being the willingness to take an action on this pain and acknowledging it, going, it's not going to get better until you take the action. And just more, I invite a phone call. I invite a chance of a meeting of the minds, even like this. So I know that they came from your podcast, even that just reach out and have a meeting of the minds and the willingness of hiding the pride and the ego of going, I've had enough. I'm ready to call it good and move on and go enjoy my RV life or whatever it may be, that they're ready to call it good. And so I would say just acknowledge it and being open-minded and being willing to have a Zoom meeting like this and just even a tour, but being real of acknowledge a lot of the issues that are happening. Charlie, I lost a major client. I lost my financing. I lost my major partner to an illness. And something that has really kicked in of going, I need to explore this. A lot of them will not even know. How much would you want for it? I have no idea. How is that even determined, sir? I don't even know. That's our job. And we're not doing this as a broker. We're doing this as a buyer. So we're not having representation from doing this other than from a legal standpoint, but we're not representing them. But we're definitely going to come in and at least plant the seeds and send every one of them that tunnel. Print it out. Have them put it on their mirror. Said, sir, you're a CEO inside my tunnel, Charlie's tunnel, right? Where is that? You see the end of the tunnel, but I'm not quite there. I'm in my quicksand. Unless you take action, just simply reach out and let's explore that option to get you to the end of the tunnel, get you exit. Because if I can get them over 3 million and EBITDA or better, we can cash them out.
Yeah. Awesome. Well, thank you. And is there any place they can reach out to you specifically? I can put in the show notes at your LinkedIn, or you have a website or whatever.
I like it. I'm more old school. Just send me an email if you want, an industrial exit strategist at Gmail. Like what you see up there by my name up there, just industrial exit strategist at Gmail. Reach out, say hello, and or you can reach out here to Pete and say we found out about you through Pete's podcast and would like to open up a meeting of the minds with our team and to see what level we think we could go. How do we want to grow it? Do we want to just get out of it? There may be opportunity to scale it and then exit. That's
Yeah.
something, another
Yeah.
possibility. So it's not just about getting it out, because some of these owners will say, man, I really like what I can do. I've just got some missing links. So I want them to know that the capital and the exit's the easy part. If somebody were to come in there, and I used to relate this to an open-ended book, and I said, you put your hands together where your pinkies are touching and your thumbs are touching, and if you open it up, and if the company had access to an open wallet, what could you really do? Because the capital is the easy side. The hard side is getting everybody on the same page and knowing that we're not doing this for a 40-year job. The hard part is finding the right kind of deal to match the capital, not the other way around. And so I don't want any kind of money for it. I just want to have a chance of a meeting of the minds and planting the seed for that. If we do sell, what are you going to do? What does that look like? And have them reach out. So industrial exit strategist at gmail.com would be a great way, or have them even through you. You can put that in a link in your podcast there, or even reach out through you. Because I would love to have a level of even a three-way meeting of the minds with you, even in the middle of this too, since they're finding this out through you, even open up that door to have a Zoom meeting like this, have some questions, Q&A time, and just planting those seeds.
Awesome. All right, Charlie. Well, thank you for your time. Well said. I appreciate all the insights you gave. It was good having you.
That likewise. Thank you for your extended time. I appreciate you very much.